Welcome back to the Rob Berger Show. Today, when I woke up, I do what I normally do, and that is start reading the news. And I came across an article in the Wall Street Journal. I'm looking at it now. It's called Investors Approaching Retirement Face Painful Decisions. And it's a fascinating article about how retirees, many of them, have sold all of their stock investments since February of this year. The market declined, as we all know. It's come up since then and now back down. I'm recording this in the middle of June 2020. But of course, it lost over 30% in a relatively short period of time. And according to the Wall Street Journal article, and they used a study by Fidelity, nearly 1/3 of investors age 65 or older sold all of their stock holdings between February of this year and May. That is an alarming statistic, and it is an absolute recipe for disaster if you're in retirement. It feels like the safe thing to do. When you're in retirement, who wants to see your portfolio drop by tens of thousands, maybe in some cases hundreds of thousands of dollars over a short period of time? So what I want to do in this video is link two retirement money management strategies. There's a connection between two strategies that I don't think a lot of people appreciate. So what are those two strategies? Well, the first is called the bucket strategy, and the second is called the 4% rule. If you're familiar with them, you may be scratching your head and saying, yeah, Rob, I get they're both related to how we should manage our investments and spending in retirement, but I'm not quite following what the connection is. So in this video, I'm going to tell you what that connection is and how it can help you if you're in retirement or near retirement weather a difficult market. Now, in the article I mentioned, there was a gentleman they featured. He's a doctor. He's 62 years old, so he's near retirement. And because of COVID and the impact on the economy, he's actually struggled. His medical practice has actually gone down. He had to furlough a lot of his employees because folks aren't going to the doctor as much unless they absolutely have to. And so his practice has declined. He's had to take on some loans. And so out of fear of the market mixed with a lot of realities that he's struggling with in his medical practice, he has sold a lot of his stock holdings. But it's one thing he said, the Wall Street Journal quoted him, that really caught my attention. Here's what he said. He goes, "I don't have 10 to 15 years left to recover my losses." And of course, initially that seems to make sense, right? If he's 62, let's say he's going to retire at 65, does he really have 10 to 15 years to recover his losses? Well, actually, he has probably 30 or more years. And that's the thing that a lot of people don't realize. When you're in retirement, you're still a long-term investor. If we assume, at least for planning purposes, that we're all going to live to be whatever, say 95 or 100 years old, then at 65, you still have 30 years or more as an investor. That's certainly true of this doctor who today is 62. So actually, he does have 10 to 15 years, if not more like 30, to recover from his losses. Of course, that's only part of the story. The other part, as he pointed out in the article as well, he's going to need some of his investments, some cash, to live on when he enters retirement. So how do we balance those two things? The need for cash in retirement to pay for living expenses, but also the need to get the long-term returns that only stocks can provide so that you don't run out of money in the middle of retirement. And that's where the bucket strategy and the 4% rule come together. So what are they? Well, if you're not familiar, the bucket strategy is a simple way to allocate your money in retirement. So before you get to retirement, when we think about asset allocation, we always think in terms of percentages, right? So maybe you have a 80-20 portfolio, 80% stocks, 20% bonds, or maybe it's a 70-30, a 90-10. Whatever it is, we think of asset allocation in terms of percentages. Once we get near and then enter retirement, however, we have to change that because we're actually spending some of this money. So the idea behind the bucket strategy is really quite simple. You have a bucket for cash. And rather than thinking of that bucket in percentages, you think of it in terms of how much money you'll need from your investments each year for living expenses. And so typically what I see for that cash bucket is having 3 to 5 years of living expenses set aside in cash. It could be a checking account, savings account, certificate of deposit, maybe even a short-term bond fund, or even some combination of those. But these are investments that are not going to lose money. The money's going to be there when you need it. Maybe they earn a little bit of interest, not much, but again, it's not there to power your returns. It's there to pay for your living expenses. And so you figure out what you're going to need over 3 to 5 years, and that's after factoring in Social Security and maybe a pension and any other retirement income you have. Factor all that in. It's okay. What do I still need beyond those sources of income to pay for my living expenses? And let's just say it's $50,000 a year, and then you simply multiply it by 3 to 5 years. If we assume a 5-year cash bucket, then 5 years times $50,000 would give you $250,000 in your cash bucket. Now that's the bucket strategy. What do you do with the rest of your money? Well, you divide that, could be into just one other bucket where you have some combination of stocks and bonds. Some folks actually use 3 buckets. So they have their cash bucket, then they have another bucket that's maybe 2 to 3 years worth of living expenses in intermediate term bonds. And then they might have their final bucket that's for long term, that's mainly stocks, maybe some bonds as well. Whether you divide your money into 2 buckets or 3 buckets, you still have to figure out what's your overall asset allocation. Fine, you've got 3 to 5 years in cash, but when you look at the big picture, all of your money, your cash and your investments, what's the right asset allocation in terms of percentages? And that's where the 4% rule comes in. So the 4% rule was developed by an advisor by the name of William Bengen. He wrote his first paper on this that kind of became famous in the world of financial planning in 1994. And here's what he concluded: that you could spend 4% of your investment, your total portfolio, in year one. And then after that, adjust whatever amount that was by the rate of inflation and do that each year. And if you do that, you're likely not going to run out of money in retirement. What he tried to determine was, would your portfolio last at least 30 years? And he found that if you started with 4% and then adjusted it each year for inflation, your portfolio would last. And that's true pretty much regardless of when you retire. He looked at retirees that retired right before the 1929 market crash. He looked at retirees that retired just before the really bad economies in the 1970s, where the word stagflation came into being. He looked at some really bad markets, and even in those bad markets, following the 4% rule generally allowed you to have a retirement in which you didn't run out of money. But here's the key, and what many people don't focus on. He had to assume an asset allocation. And what he assumed was that you had a 50-50 allocation in retirement. Say 50% in an S&P 500 index fund, and 50% he used intermediate term treasuries for his bond allocation. A 50-50 portfolio. Now he looked at other allocations. He looked at 100% stocks, he looked at 100% bonds. What he found was, for portfolio longevity, which is what he called it, that is, you want your portfolio to last through all of retirement, you really want a stock allocation somewhere between 50 and 75%. If you go above that number, then in a really bad market, you could lose too much in a short period of time, and that could wreck your retirement. If you go well below the 50% stock allocation, then you don't have the returns you need in order to power your portfolio through a long retirement. So he found 50 to 75% was sort of the sweet spot. Now, the difficulty with that, again, for a retiree is, as we've seen in the current market, it can be tough to stomach a 30% drop in the market when you're at a 75-25 portfolio or even a 50-50 portfolio. And that's where the combination of the 4% rule and the bucket strategy, I think, can come into play to help. Given that we have a cash bucket of, let's say, 5 years, that should at least help to some extent. It won't alleviate the emotional pain we go through when the market falls, but at least we know we can pay our bills for the foreseeable future. At least we know we've got money in the bank that's going to last us at a minimum 3 years, and I think probably more like 5 years. That will help us weather the market declines. At the same time, we need to look at our entire portfolio, including the cash bucket, and ask, are we at least at 50% stocks and no more than 75% stocks. If we are, then we know we're in the sweet spot of the 4% rule as envisioned by William Benjamin. Now, we all know there are no guarantees in life. We don't know what the future market's going to do. We don't know what inflation is going to look like over the next 30 or 40 years. But I do take some comfort in the fact that the 4% rule has been tested across all kinds of markets, good and bad. So again, if we take the bucket strategy, that can relieve some of the short-term stress of our living expenses. And if we always keep an eye on the overall portfolio, aiming for somewhere between 50 and 75% stocks, we know we satisfy the requirements of the 4% rule as envisioned by Benjamin and a lot of other studies that have occurred since 1994. The real key takeaways are this. If you're nearing retirement or in retirement, you're still a long-term investor. Certainly if you're in the early stages of retirement, and we assume, say, a life to 95 or 100 for planning purposes, you still have decades left as an investor. And so we need to think like long-term investors. At the same time, we know we need immediate cash, and that's where the bucket strategy can help. Now, I've written an article about this. I'll include a link to it below the video. And if you have any questions about this, just leave comments below the video. I monitor them, and I will certainly reply to them. Hey, hope you have a great day. And until next time, remember, the best thing money can buy is financial freedom.